Steven says, great, awesome. Thanks everybody for coming. Greatly appreciated. Hopefully, we'll spend the next hour plus together, take as much time as we need, and hopefully we'll cover some good ground and have some really good dialogue also. Dennis, audio is fine, awesome. Thanks, Dennis, for being here. And so, we'll get started right on time. We'll just wait for a couple of minutes here. It's 11:58 East Coast, 10:58 Central Time. I know we have folks from all over the place here today. Again, greatly appreciated. These online futures trading phenomenon is a global event. I mean, everyone from all corners of the globe are participating. It's really exciting. And we'll get into a little bit. We're going to cover. We'll cover a lot of ground. We won't get too into, we won't freak anybody out and get too far into the weeds. But we'll definitely cover a lot of ground and have some fun. So we're going to get started here again in 1 minute. We'll just kind of wait for the. Make sure everybody has an opportunity to log in for our start time. Right now, you see just the registration page. I think that everybody saw to begin with. Registered when we started. So let's give it 30 more seconds. We'll pop in. Again, thanks for coming. Chris has questions already. I love it. About the strategy builder. Could you please point me in the right place? Yeah, we will definitely point you in the right place, Chris. And one of the things I'm going to do. So if your question is a little bit off topic or I don't know the answer, which is very possible, if you send me an email, I will respond to every single email that I get. I'm going to type in my email address right here. It's Jim Cagnina at NinjaTrader.com. So feel free to reach out, and I will do everything in my power to help get you in the right direction, answer questions. Dave's extremely interested in ATM. Okay, so today we're going to focus I'll get into that. I'll cover that also, Dave. So just hang tight. We'll get into that as well. So let's go ahead and get started here. I think we're right on time. This is Jim Cagnina with NinjaTrader. Today's event, Futures Trading 101. And this is really any level of trader could be here, right? We're gonna have people that are brand new to trading futures or maybe curious about trading futures. Maybe you're trading equities or stock options or over-the-counter Forex. Or crypto or something else, or maybe you're not trading anything at all. That's okay. So we're going to kind of walk through the whole story about the futures trading industry and how we've evolved to the point where we're at right now. Now, the good news is I do not have a PowerPoint, so I'm not going to bore you with PowerPoints. We're really going to use the trading platform to talk about what this is all about. By the same token, though, let's be interactive. Feel free to ask questions, type them into the question and answer box. I'll do my best I can to answer them. And we have a little bit of flexibility on the agenda that way. The event is scheduled for 45 to 60 minutes. I highly doubt we're going to finish in 45 minutes. We got a lot of ground to cover, and I want to be patient and take my time and make sure that I'm articulate as we go. Dave, I typed it into the question and answer box. Our host will help. I have Josh is probably here with me to help out on that. It's jim.cagnina at ninjatrader.com. We'll make sure you get that email address. And then I do want to remind everybody that trading futures options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you do have a high combination of leverage and volatility, and that leverage is available to you. And that could be an equation for opportunity, but it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition: money I could afford to lose. It doesn't change my lifestyle or lengthen my retirement horizon. And I understand everybody's unique and different in this world. So just be comfortable, be in the right spot, and don't be overstressed. I'm going to be using the NinjaTrader platform. I have version 8 installed and running, and we're going to focus on going through the platform and talking about the whole futures trading industry, if you will. And I'm logged in a real-time simulated live account right now. So let's take a peek. Now, I understand there's a lot of stuff. If you're brand new to futures and you're seeing my desktop, this is how I have my desktop set up. And at first glance, it could be intimidating, but it's really not. It's very modular, depending on how many monitors you want to have and what your setup is and what your techniques are. It could be a lot simpler than this. It could be more complicated than this. But this is really, really pretty a basic setup. And before we get into that, futures trading. How did this thing start, right? All right, so everybody knows, or maybe not everybody knows, but trading's been around a long time, right? This is a human being phenomenon, right? Greeks and Phoenicians are established trade routes and trade partners through the Mediterranean way back in the day. Trade first started, and from an organized exchange point of view. Some would argue the Royal Exchange in London in 1571 was the first organized type of exchange to trade not only products but things like stocks. The Dojimi Rice Exchange, 1667. Now Dojimi Rice, the name speaks for itself. It was a rice exchange, right? And you might recognize the word Dojimi or Doji, which is a technical analysis technique that we use in futures. Chicago Board of Trade, I believe, started around 1848. So we have a lot of experience in the Chicago, emanating from Chicago, being in the Great Lakes and having access to waterways and distribution systems to the Midwest. That kind of started it as what we call a traditional commodity market, right? So a lot of people still associate futures markets with commodity markets, and it's much more than that. And we'll talk about that as we go forward here. But this early days of the Chicago Board of Trade were commodity markets, right? Wheat, corn, grain, those kind of things. CME then jumped in the bandwagon in the 1800s. It was originally the butter and egg exchange, and then after World War I, it was really more formalized as the Chicago Mercantile Exchange. So I started in this business early 80s. I argue with my mom when I actually started, but I think it was 1981. I was on the floor of the Chicago Board of Trade. We didn't have the electronic systems that we have now, and it was all floor driven, right, and phone call driven, and with locals and with brokers and with all sorts of stuff going on. It was like the heyday of the pit trading when I was down there. I was in the U.S. Treasury bond pit, the 30-year U.S. Treasury bond pit, which was one of the biggest ones. I just graduated from high school and I had a summer job, and that's kind of how it started my interest in this whole business. 1992, the CME came up with the Globex electronic exchange. Right now orders are being able to match electronically. Buyers and sellers are matched electronically. There's no need to have, somebody standing in the pit, and making a trade for you with another trader on the other side of the pit, right? It's all electronic. And pretty quickly after that, and in my mind, this is when everything changed. Pretty quickly after that, in 1997, the CME Group launched the E-mini S&P 500 contract, which is one of the most popular contracts today. And, it's on my screen right now, and we'll talk about that as we go. But they launched that tool, and it was basically they expanded the participants, right? So now anybody with an internet connection and with a broker and with a trading platform could participate electronically in the E-mini S&P. And it was a smaller size contract, right? So it was easier for retail traders and regular traders to participate alongside with the big banks and the big clearing firms and the big institutions. All electronic, and it was fair, first in, first out. Your order was processed electronically on a first in, first out FIFO basis. And so that kind of really started this whole online futures trading revolution that we're seeing right now. And then to kind of kick into gear, what the CME did next, which was great, on May 6th, 2019, they launched the micro E-mini S&P, which is even a smaller size contract. And at this point, and I'm going to quote somebody right now that retail futures became accessible to everyone, right? And it did. It really did. You could literally fund a futures trading account with hundreds of dollars instead of thousands of dollars, and you could participate with the micro E-mini S&P. And there's many other micro products that followed. And we'll talk about all the different asset classes and all the markets that are available to us as we go. So let's take a peek here. And yeah, I believe this is being recorded, and I think we're going to do it again next week, whoever asked that question. Thanks for that question. Again, I'm going to expand my question and answer box so I can see all the questions as they come in. So let's take a look at all the different pieces of the trading ladder, of the trading platform rather. In the trading ladder on the right, the Superdome, this is really where the rubber meets the road. I mean, this is one of the things that's unique about futures trading. You don't get this type of trading ladder or price ladder or dome with other conventional types of trading, right? So, you know, in an over-the-counter Forex account, you wouldn't get one. In an options market, you wouldn't get one. And you'd have to be maybe a pattern day trader to get one on with the stock, which is stock trading, right? If you're day trading stocks, you might have to be a pattern day trader, which means you have a minimum account size of $25,000, right? So a lot of potential participants are kind of frozen out of having access on the equity side, whereas on the futures side, you know, if you fund a micro account in the hundreds of dollars, you can have access to it. And not only that, what this trading ladder is showing us is the entire market, right? So this is the CME Globex, and I have the E-mini S&P market shown right now, and that's based on the S&P 500 stock index, which is, you know, widely followed throughout the world. And it's, you know, you turn on the television in the morning and you'll see the E-mini S&P being quoted on TV before the cash New York market opens up. So let's take a look at what this is. So in the middle, and I'll just kind of move this over a little bit so I center it a little bit better on the screen here so we can see it. On the middle, we have prices, right? This is called the price ladder. And each price increment is the smallest price increment that the market allows, right? And each increment's called a tick, right? And there's as many ticks as you want to scroll up high and down low. So this price ladder just kind of shows you where the market's trading. And I'm going to freeze the ladder right now. This yellow area here is like, hey, the last transaction happened at 44.40 3/4, right? This market's traded in quarter points rather. Each quarter or each tick is worth $12.50 a contract, right? And so if you have more than one contract on, if you have two on, each tick would be double that, you know, worth $25 a contract. A full point for one contract is 4 ticks or $50. And that's how this particular market works. Every single futures market is priced. You have different tick increments and you have different prices. But this is how the stock index futures works for the S&P 500. Now, and you can see it moves around, right? The prices move around. So as buyers and sellers are doing transactions, you know, price moves around. This is a supply and demand phenomenon, right? The market kind of moves around. I'll freeze it again. Now, on the left-hand side, you'll see a bid column. And on the right-hand side, you'll see an offer column. And what the bid column is, let's start with the bid column. And you could see numbers 10 ticks below the last traded price. And you could see offers 10 ticks above the last traded price. So this is considered a level 2 view, 10 ticks deep, level 2 view. And again, unless you're a pattern day trader, you haven't seen this before, most likely. So what are these numbers though? What do these numbers mean? Well, these numbers are contracts that have been sent to the exchange, are waiting in the CME Group order book to be filled at various different prices. They all represent limit orders. So on the left-hand side, these are traders, whether they're individual, retail, commercial, hedgers, it doesn't matter, that have sent orders to the exchange to buy an E-mini S&P contract at various prices. The right-hand side represents orders that are sent to sell E-mini S&P contracts at various prices. And you could see, and it's dynamic, right? These numbers are moving, they're changing. People are adding limit orders to the CME Group book. They're deleting orders. They're canceling, replacing orders to different prices. So you see these numbers do move a lot right now. Things aren't too incredibly volatile right now. So we're kind of trading, you know, around 44, 40 and a quarter right now. It's so things have slowed down. It's lunchtime, and that kind of makes sense. So, and I'll go ahead and freeze that again. So now, when you send an order, that it's sent and accepted on a first in, first out basis, which means, you know, I will be in line behind everybody that was there before me, and then anybody who sends an order at the same price after me will be in line behind me. And as you move up to the front of the line, if the market's trading at that price, then you have an opportunity to get your trade executed, or get what we call get filled, right? Get filled. So let me just kind of glance over here to the questions and answers, because I think a lot of them are coming in. Cynthia, I'll cover your options later. There's a few different options that you can have. Eric says the DOM are the pending limit orders that can be canceled to trick you. Well, Eric, I don't know. You might read the news too much. In a market like this. So in a market like this, it's very deep, right? There's a lot of market participants. There's a lot of volume, and the bid-ask spreads are pretty good, right? And these numbers move around really quickly. So this market is so thick and so big. What you see is pretty much what you get, in my experience. So I'm going to go ahead and just we'll go ahead and let's say I want to buy a contract at 44.40 even. I'm just going to move my mouse over to the bid side, and I'm going to click once. And so you could see my order now. I'm behind 208 other orders, and it's now there's, you know, volume accumulating behind me. It's going to move around a lot. And that's how my order is graphically represented, right? But I'm in line, right? I'm in line to buy an E-mini S&P contract at 44.40. And by doing this, what I'm saying is, in my opinion, if I could buy a contract here, I feel that the price is then going to appreciate, right? And I want to sell it at a higher price, right? So my opinion is that, you know, at this particular point in time, that, you know, the market is, you know, will eventually go higher than just the 44.40. And so that's how I'd express my opinion and trade that way. Alternatively, if I wanted to sell a contract, I just move my mouse over to whatever price I'm interested in, let's say 44 even, click once, and I would have sent a limit order to sell a contract, right? To sell a contract. And to move it, to change your mind, just click, and it cancels and replaces that order. It's really that fast. Just click and click, cancel and replaces that order really fast. Again, another unique thing about futures trading is that kind of mobility, is that kind of flexibility, and you could be quick about it if you want. It's a cancel an order, just hit the X. And you can cancel this one too. Click the X. So, and there's the trading ladder itself has other ways to cancel orders. You can close positions and orders with that button down here, and we won't get into too much detail. But the main thing about the idea of the DOM and about is it really demonstrates how bids and offers work in an electronic environment, right? This is literally at a computer sitting at the CME group, and it's literally matching things up, which measured in milliseconds, by the way, the data feed and also the execution speed once you place that order. So it gives a couple of reasons of, you know, reassurance. It's transparent. You could see the bids and offers. That's kind of number one. Number two, it's fair. First in, first out. Number three, it's super quick, right? Super quick. Old days that you would call your guy on the floor. They had these rows of telephones, and then the fella on the phone or the gal on the phone would take your order, write it down on a piece of paper, flash a sign to the guy standing on the outside of the trading pit, or maybe handing a piece of paper to a runner. That was my job, and run it into the pit to the broker, the guy who was going to execute the trade for you, and he would execute the trade for you. And then they would fill out the piece of paper and send it back to the runner, which was me. And I'd go back to the phone and give it to the phone guy. He'd call you back, say, okay, yeah, you bought a contract at 44.40. And now this process sometimes happened right away, within a couple of minutes. Sometimes it happened, a couple hours later, depending on how busy the pit people were. So now you don't have to worry about that, right? We're electronic. We match them up right away. You see it right at your screen, wherever your screen happens to be. Okay. So that's That's the trading ladder, and it's very powerful. With Ninja, you could have as many open as you want. You could have as many different markets open as you want. I just have one up right now for demonstration purposes. I'm squeezing all my windows into one monitor instead of the multi-monitor setup that I have. So I want to show everybody what it looks like. Okay, so and again, well, we'll get more into Forex alternatives and stuff like that as we go. Let's take a look at the market analyzer. This is this window right here. Think of it as a quote board. It's really what it is, right? We have the instrument in the left column. We have the last price in the second column. We have, I have the daily volume in the third column, and the net change from the previous day in the right column. And you can see the E-mini S&P as an example. We're up 59 points since yesterday's close. This is very, very, you could dynamically actually change your view. You could add columns, you could subtract columns. It's very customizable and easy to do. And this is just how I have mine set up, right? And this is actually how I actually have my real platform set up. So this is kind of a quote board. We call it the market analyzer. There's a bunch of stuff you could do with it, changing colors and columns and other things, but we'll keep it with this view right this very second. It's called the market analyzer. Now you'll see I have a bunch of different markets up here, right? Now I have it broken up into asset classes, and we talked about commodities being associated with futures trading, which is still true, but there's pretty much any asset class you could think of is represented in a futures market, and most of them are pretty liquid, right? So let's take a look at some of the ones that I have up here. I actually have the E-mini S&P up at the top because it's the one we use the most, and it's very popular. But you could see from the equities, we'll call them, right? The stock index futures. We have a couple different ones. We have the NASDAQ, which is the NQ. We have the Dow Jones, which is the YM. And we have the Russell 2000, which is the larger small cap stock index that's also very popular. So you have large cap to small cap to blue chips to techs, all represented in a stock index future market. Now, one of the things you'll notice is, hey, Jim, there's an M here. Why is there MES? You have an ES, which is your ticker symbol for the E-mini S&P. Then you have an MES. Well, remember what we mentioned earlier is in 2019, the CME group said, hey, let's create the identical market, but let's make it 1/10 the size smaller, right? Let's make it 1/10 the size smaller. So depending on the amount of risk capital you have and depending on what your trading technique is, you could participate with a smaller size contract. And that's called the micros. They're very popular and they're very liquid. As a matter of fact, if you take a look at the NASDAQ versus the micro NASDAQ has more volume than the classic E-mini NASDAQ. So that kind of just tells you kind of the application of this market and how you could participate in a liquid way, right? We want a liquid market. We want a tight bid-ask spread. We'll talk a little bit more about bid-ask spread as we go forward. So let's go to the next asset class. Now there's other stock index futures to consider. I mean, there's in Europe at the Eurex exchange out of Frankfurt, you have the Euro Stock 50, you have the DAX, you have the micro DAX. They followed suit once the CME got successful on it. So depending on where you're located in the world, you do have access to other stock index futures. So I just named a couple of the easy ones. The next asset class I have listed here is energies, right? On energies, the crude oil contract that's traded at the CME group is probably one of the most popular ones. It's called light sweet crude. That's the quality of the crude. It's WTI crude, which is based on West Texas Intermediate crude is the name of it. It's very popular. It's very liquid and it's widely traded. There's other benchmark crude oil markets, right? This is one of them. Brent crude might be one. Dubai crude might be one. This is the one we're focusing on here in the U.S. mostly. Micro contract for the CL. You see that M in front of the ticker symbol, MCL. Natural gas, heating oil, and I believe heating oil is referred to it. Now it's changed since I've been around. it's New York Harbor low sulfur diesel is the name of the contract, and you can see the daily volumes here, and showing you what the liquidity is. So those are kind of the popular energy markets. Forex markets, FX markets, and we're going to talk a lot about, not a lot, but we're going to talk more about over-the-counter Forex later. You could trade the futures contracts of the currency pairs, of the crosses, right? I have only a few listed. All the majors are available. A lot of the minors are as well. I got the British pound sterling versus the US dollar is the very first one. I have the Euro FX versus the US dollar, the second one. Japanese yen, US dollar is the third one. And some of the Forex traders might recognize that the quote is inverted, and it is. In futures trading, it's the yen versus the dollar instead of the dollar versus the yen on the cash Forex side. But that just makes the math easier, in my opinion. And, other ones that come to mind, include the Canadian dollar, the New Zealand dollar, the Swiss franc, the Aussie dollar. And, again, we get all the majors out of the way here. And there's a lot of advantages to trading FX futures over cash Forex. I'll talk about those in a little while. Let's go ahead and take a look at metals, right? Precious metals, industrial metals. We got gold, silver, copper is another one that's relatively popular and has a lot of volume to it. And there's different reasons why you might want to trade one of these particular markets. And gold is thought to be an inflation hedge, right? It hasn't really demonstrated that lately, but that's at least what folks think or tell me. Hey, this is an inflation hedge. This is how this market's going to move. I don't know if that's true or not, but it's very popular. We have 191,000 contracts traded already today. The interest rates are in the news as well, right? You could pretty much trade the entire yield curve on the future side, starting on the high end from the 30-year Treasury bond, and that was the pit I was in when I first started in this business way back then, when I was a younger man. And that's the ZB contract. And since then, they've come up with an ultra bond, which is a true 30-year bond. In other words, the duration is 30 years instead of maybe 26 years or something like that. 10-year note, 5-year note, you have access to a 2-year note. The Fed funds is a futures market. And it's very popular futures market, which represents the smaller end of the yield curve, the lower end of the yield curve. And you hear the Federal Reserve, the FOMC meeting yesterday talk about Fed funds rate, right? That's how they target in real time their fiscal policy, their monetary policy. Is one of the tools in their toolbox. So all of those interest rate products are available. And then finally we get to agriculture, right? I only have a couple of them listed right here, but it's the traditional commodity stuff, right? Soybeans, corn, wheat, soybean meal, soybean oil, oats. And then if you want to coffee, cocoa, sugar, all of these types of traditional commodity markets are also available electronically and very liquid and very popular. So you have all of that. You have access to all of these different asset classes. We're no longer just trading corn. This is a totally different thing. If you want to trade weather futures, which isn't really a retail market, you can do that. So in any event, those are the different asset classes as we go. I am going to circle back to a lot of the questions that are specific about tick sizes and about what's better than, this, is this better or that better? Pammy, there is a micro gold. Thank you for that question. Micro gold also is accessible, right? And it's you got to look at the volume and make sure that the volume is liquid when you're trading it. But you could tell that by the bid-ask spread. And let's just go back to the dome here. The bid-ask spread is the difference between the highest price someone wants to buy and the lowest price someone could sell. So this is the bid-ask spread right now, and it's one tick usually in liquid markets. It's very, very tight. And the bid-ask spread is part of your transaction cost, if you think about it. So keep that in mind. You want to make sure that the market's liquid, the bid-ask spread's reasonably close together, and make a judgment call. Is that market liquid enough for me or not? In this particular market we're looking at, absolutely is, in my opinion. Okay, so we talked about the main markets. We talked about the contracts. One of the other really unique thing about trading futures, in my opinion, this is an awesome feature, is these markets are nearly 24 hours a day. So we open up Sunday night, and I'll use Chicago hours, right? 5 o'clock Sunday night, trade all night, trade all morning, trade all day, close at 4 o'clock Central Time in the afternoon. That's a 23-hour session. That's considered the same session, right? That's considered one session. That's the day trade, right? That's the day trade. Then from 4 o'clock to 5 o'clock, the market's closed. And this is most of the markets, just about all the ones we look at. From 4 o'clock to 5 o'clock, the market's closed. Then at 5 o'clock on Monday night, the cycle repeats itself. It goes all night, all morning, all afternoon until 4 o'clock on Tuesday, right? Another 23-hour segment. So overnight, as odd as this sounds, is only 1 hour, right? It's only 1 hour. And then we'll talk about margins and what that means to you. But the cycle repeats all the way through Friday afternoon. Friday afternoon, we're done until Sunday. Nothing to do on Saturday. Take the day off. Enjoy whatever you want to enjoy on Saturday. You're good to go. So that's one of the unique things. Why is it so unique? Why does that give me any advantage? Well, I'll tell you why. Maybe there's going to be some earnings announcements after hours that could affect the stock index. Maybe there's a geopolitical event that could affect the market. Well, now not only could you express your opinion on that event in the evening hours, right? You don't have to have a special account to do that. You could actually manage positions in the event that something like that happens and try to take advantage of it, or at least try to protect yourself. So that ability to access the markets after the US hours is important. The whole world isn't just the US. There's traders in Europe, there's traders in Asia, there's traders in South America, there's traders, all over the place. So you have that ability to participate as easy as I just showed how to place a trade on the dome in the middle of the night, as an example. So I'll show you that also, Pam. Everything's pretty much right click. Mostly right clicks on something and something happens. And just by the way, as a side note here, this window here, again, modular, move it around, put it on however you want it. You could add tabs to the bottom of it. This is a chart, right? And if you've traded before, you've seen a chart, right? Everybody knows what a chart is. Very powerful. A lot of stuff you could do here. I won't get into too much detail on it, but that's a chart. These are 3 other charts I just have listed up here. And I'm just kind of looking. I want to, here's the stock index future on the big chart in the middle. I have crude oil down in the lower left. Lower center, I have the 10-year Treasury notes. And then on the lower right, I have the E-mini S&P. And this is just, again, my personalized version of what I want my desktop to look like. Okay, so we talked about 24-hour markets. Let's talk about capital efficiency, right? So, and this is, related to risk, right? So you do need to be careful. But we talked about, pattern day trader, $25,000 minimum to get to be able to really day trade, right? So it locks out a lot of folks. That's kind of number one. Number 2 is an example on the equity side. You have the uptick rule, right? There's an uptick rule where, okay, you can't go short on a downtick or on a side tick. You got to wait for an uptick to go short, which kind of contributes to exasperates the problem, right? Adds to the cost of your trade. So from a capital efficiency point of view, though, instead of putting $25,000 in an account, I could put a lot less money in an account, and I could trade a futures contract. You trade as low as $3,000 minimum for an account, or even a $400 minimum to sim trade on NinjaTrader and trade a couple of micro contracts. So you have that ability to be more capital efficient without having to fully notionalize or fully fund an equity account or any other kind of account for that matter. So there's certain capital efficiencies that are afforded to traders on the future side. Now, margining is another interesting difference between, think of purchasing power margining. And remember, the lower the margin, the riskier the trade, right? Margins are a double-edged sword. They work for you as well as against you. They magnify gains as well as magnify losses in relationship to your account size. So keep that in mind. All right, Cynthia, I'll get to, generally speaking, you'll have to have a separate account to trade futures versus stocks. So you could do it, Cynthia, and a lot of people do it, but you would have a separate account. Sorry, I digressed a little bit. So let's talk about this idea of margining. Now, there's a day trade margin. In other words, there's folks that just day trade, right? So you want to open a position in a session and close a position that same session. Whether you go long and then sell one, or you go short and then buy one, you're liquidating your position before the close at the end of the day, or you're liquidating several positions, or you're buying and selling several times a day. But at the end of the day, for a day trade to be called a day trade, it's closed by the end of the day, by that 4 o'clock period. And those margins are set by the broker, and they're a lot less than the margins that you would have otherwise. So that's kind of number one. Now, there's overnight margins, which are established by the exchanges, and there's no discretion on those. The CME group decides what the margin is, and that's what the margin is. So let's take a look here. Let's take a look. I'm just going to go ahead and put a random sample trade in. I'm just going to buy a contract here, and you can see, it's highlighted where the market is and where I bought my contract on the trading ladder. And then let's take a peek up to the control panel here, and it's going to show me, let me open this up a little bit, how much day trade margin or purchasing power I have employed in my account, right? So it says $500. So for that one contract that I just put on there, that one contract, I've used up $500 of my purchasing power, or my total available margin to me, right? And the software smart, it shows you what that is, right? And this is just a simulated account. Cash value is a little less than 10,000. At this, but the previous column here shows initial margin. Now, this initial margin is what the exchange would require that you have in your account if you wanted to hold that position past 4 o'clock. So you could see that the position traders now have to have more money in their account to hold positions for a longer period of time. And people do that. Now, the other thing that's very important to understand is this is the E-mini S&P market that I just did that sample trade in. And keep in mind that the micro version, there's the micro MES version, is 1/10 the size, smaller, right? So your intraday margin would be $50. Your initial margin would be $1,210. Okay, and now again, you're more capital efficient. You could hold that position over for a longer period of time. And we're going to talk about notional value and what that means to you in a minute. Actually, let's talk about it now. Let's just talk about it now. Let me give you, I do have one, I apologize in advance. I do have one, I do have a spreadsheet. I'm going to move this over here. All right. So let's talk about this right now. I got a couple, I have some examples. I have a winning, classic E-mini, the big E-mini example, winning trade. I have a losing trade example. I have a micro winning trade example, and I have a micro losing trade example. Let's go through all of those. So let's assume we're going to trade the classic E-mini S&P, which is kind of the trade we just have on, and we're going to do one contract, just one. And let's assume our purchase price is $41.20, and then we sold that contract at $41.24, right? So we would have made 4 points, right? We would have made 4 points on that transaction, and our profit and loss would have been $20, right? How did I calculate that? Well, it's $50 a point per contract times 4 points. And we got 200. The day trade margin we employed for that trade was $500. Now, what kind of leverage are we talking about here? So the notional value of this contract, in other words, the amount of S&P 500 you control, the value of that position is the calculation is this: $50 times the price, right? And in our example, $50 times the price comes up to $206,000 of notional value, right? That's a lot of control, right? Especially with the $500 day trade margin. We're at a 400 to 1, leverage ratio. That's a lot, and it's probably too extreme for most folks. But again, you get a sense of how that relationship works between margin, purchasing power, for day traders and notional value. And nothing in the equity world comes close, right? Nothing. And remember, it's a double-edged sword, right? Leverage works for you as well as against you, but it does give you the ability to be capital efficient with your trades. And the software is pretty handy and nimble, allowing you to place stops and place targets in all of those different types of orders. Let's go down to the next line. E-mini S&P, 2 contracts, buying at 20, again, selling at 24, 4 points. This time our P&L is double, right? Because we did 2 contracts. It's multiplicative math. Hopefully I'm saying that right. Multiplicative math. And then, but we've used $1,000 of our day trade margin, right? So if you had a $3,000 account, you would use 1/3 of your purchasing power right there. Notional value is double. 412,000, right? And so it scales up that way. And then the last example is just a 5 contract trade. Everything's multiplied by 5. You've used $2,500 of your day trade margin. Let's take a look at a losing trade example. Losing trade example, the exact same thing. 1 contract, 2 contract, 5 contracts. We lose 4 points. And then our P&L is minus 200, minus 400, minus 1,000, right? The day trade margin numbers are the same. Notional value is the same. Let's cruise down to the micros. On the micro side, everything's 1/10. So in my example, let me see if I can get it all on one screen here so everybody can see them kind of side by side. Try to do that without, well, we'll start with the winning. We'll start with the winning one. So it's 1/10, right? Everything is divided by 10. A 4-point winner is P&L is $20. Day trade margin's 50. And the notional value, though, is still pretty big. It's 20,600, right? So this is another way to participate in some of these leverage product markets when maybe your risk tolerance is a little bit lower, maybe your contract size is a little bit lower. It's what you could handle and what you want to assimilate as a trader. So and here's the losing example for the micros. Everything is 1/10 the size, right? Everything is 1/10 the size. Okay. Pauline, I do believe you're going to be able to, this will be recorded on the YouTube channel for sure. I'll go over what's on my charts. Pay me, Joe, hang tight. So when time and force is day, the position, time and force is associated with the day trade. You're exactly right. We'll talk about buys and sells orders in a second. I'm not really sure what you mean by how to read buy and sell orders, but I'll spend some time on that as well. So I'm going to go ahead and lower any questions on the spreadsheet. This is it for any supplemental materials for today. Okay, so where are we at here? So we talked about, here's another big thing, right? Here's another big thing. So in this trade example right now, all right, so again, random trade. I'm just going to, again, I'm in simulated live mode. The bottom here tells me what my open P&L is, right? This is called my unrealized P&L. Let's take a look at the top here. Upper left-hand side where I have my mouse. We have a couple of columns here that are kind of important. We have unrealized P&L. We have realized P&L, unrealized P&L, and total P&L. Realized P&L represents trades that I've already closed, right? They're in the books, they're realized. So in this particular account, going all the way over to sim account 1, I've closed an account, I lost $2.50. Again, this is sim money. On the account above here, I lost $26.25. My unrealized P&L, it's still open, right? It's moving around mark to market. And you can see it's green, right? It's 62.50. We're positive 62.50. Now we're positive $50. In the total P&L column, you just add unrealized to realized. And that's going to give you your total P&L. Now it's still not realized. They still have open positions. And so it's still going to move around until I close this particular position out. So I'm going to go ahead and close it out. I'm just going to I'm doing a market order. I'm going to hit the close button. And I just close that out. Unrealized goes away. And so all of my realized trades now totaled at $22.50. Okay. But the thing that I wanted to demonstrate, the really cool thing is now my margin has been reset. My buying power is reset. I could immediately turn around and place another trade. It's immediately freed. You don't have to wait. There's no reconciliation. There's none of the stuff that you might see in equity trading and in over-the-counter forex. So that's a pretty important thing. And so, all right, I'm gonna scroll back and get all these questions. I promise. Hang tight. So margins freed up. I think we already mentioned account minimums. If you wanted to open up a $400 account to day trade, you could do that. Sim trade, sim trading is not a bad thing, regardless of who you're trading with. There's a couple different types of traders. Let's just talk about this really quickly. And I know it's on a couple of your minds. Day trading, right? We talked about day trading, opening, closing positions in the same session. There's the swing trader, the trader who might want to hold positions to take care of regular cyclical swing, to try to take advantage of or exploit regular cyclical movements in the market, which we have on a routine basis, right? The market doesn't go straight across, it doesn't go straight up, it doesn't go straight down. We could open up just kind of a chart right now and take a peek. I mean, we have a high, then a low, then a higher high, and then a higher low, and then a higher high, and then a lower low. So this is all natural movement of the marketplace, right? It's every market has. That's why we chart. That's why we have charting, so we could kind of try to predict what's in store for us, or at least what the probability is, right? So the swing trader might have a position for a day, they might have a position for a couple of days, or they're trying to take advantage of that swing that they've identified that has potential. And then a position trader, think of a position trader more as somebody who is making an investment, either long or short. They want to hold on for a period of time, an extensive period of time. All right, so we got our limit order got filled here on the trading ladder. We'll keep an eye on that in a second. Well, actually, let's keep an eye on it right now. So we're short one, right? In future trading, you could sell one, right? So let me just I'm going to go ahead and put another order in, a stop loss, and then I'm going to put another order in, a profit target. This is the anatomy of just about any trade in the world, right? You have a position, you have a protective stop, best practices, protective stop, and then you have a profit target, right? And so I just want to demonstrate how easy it is and how easy it is to manage those, your trade in this method, and just point out that from an overly complicated, it's not an overly complicated thing, right? We sold on the anticipation of it, market going down, and to buy it back at a lower price. We have our protection here, and we have our target here. I'm just going to leave that there for now. And I just randomly put those in, so do not follow that live at home. Okay. Where are we at here? So we talked about the different kinds of traders. We did the trades setup. Now, related to the different types of trades, there's different types of traders, right? There's what's called retail traders, which are me and you, right? These are folks that just want to, they want to download a software, they want market data, they want a brokerage account, and they want to trade, right? And and right now we're in the era of what's been called the rise of the retail trader, right? These great technologies that are available to us, streaming data that's available to us, and information that's streaming information, the news cycle, and all the other stuff is at our fingertips. And so this is kind of all added to the rise of retail traders, and especially with the micro E-minis. So that's kind of number one. It's the barrier to entry has been removed. Other types are institutional traders, right? You might have a money manager that's in here managing money in trading in these large institutions that are trading it. Commercial establishments. Most commercials are are considered hedgers, right? The obvious example is the farmer who wants to hedge their crop because they want to lock into a price because they're going to deliver their product when they harvest it later on in the year, and hopefully the weather is good and all that stuff. So they're locking in a price. Maybe a hedger might want, maybe an institution might want to I might have to buy some computer chips. A US-based entity wants to buy some computer chips in Japan at the end of the year, and wants to lock in its currency risk, right? And so then they can go into the futures market and put on a currency hedge. So they lock in what their price is going to be when they, 3 months later, they go ahead and they make their purchase because they have to convert their US dollars to yen to buy the computer chips. So there's all sorts of hedging examples in there as well. And then there's the systems traders, there's the algo traders, and they get a bad rap, right? Systems traders and algo traders, they're just trying to exploit, one or two ticks, and they're just trying to take advantage of discrepancies in milliseconds, and they don't provide any good function. I'm going to argue the opposite. I'm going to argue that the systems traders, the algo traders, the automated trading systems are providing liquidity. They're providing liquidity so that when you see the bid-ask spread that it's one tight, that's good for me and you, because our cost to enter and exit is less. If this bid-ask spread was 2 ticks wide, then we would add an extra $12.50 to our entry. So in my opinion, it's a good thing. They are participating in the market. They're keeping everything tight. I mean, you could even see that, between the ES and the micro ES, even though they're two different markets, they're based on the exact same underlying contract specification pretty much. And you could see the prices are totally in sync, right? And that has a little bit to do with market makers, but also to do with anybody who's trying to arb the price discrepancy between the two, because the fair value of this thing is exactly the same. Okay, so those are systems, guys. So those are pretty much the market participants, and it's big, and there's a lot of them, and it's global, and it's all over. Let's talk a little bit about some of the other things you might be doing and why you might want to consider futures trading over those. Stock options, right? So stock options. When you've come up with a strike price, you're interested in placing an order. Oftentimes the bid-ask spread is wide, right? And that's because the open interest is small, and that wider bid-ask spread is gonna be more costly for you to get in the position and more costly for you to get out of the position, right? And also with futures, you really don't have a time decay, right? So, from a long-term trade point of view, you don't have to worry about a decay in value over time. The only thing you have to worry about is an example in the E-mini S&P. Every 3 months, you'll have the contract will roll over to, because they expire, right? So the December contract, 12 means, let's go over here to the market analyzer. The 12 in the symbol means December, right? This is December 2021 contract, and it will expire. But there's going to be the next E-mini S&P. These are quarterly expires, right? And so there'll be the March 2022 contract. Then will pop on the board, and you'll be able to trade that market. Or if you're holding a position past that, which is called rollover, then you would just simply roll your position over. So from a decay, there's no time decay really here to worry about, which is really a worry for a lot of options traders. And platform confusion, pretty much, and I'll go through some of the charting and stuff in a second. If you ever tried to place an options trade or a straddle or a bull call spread or anything like that, it's really complicated. The platforms are just, there's platform confusion. I'm going to call it, and at least for me, I don't know. I'm an older fella, so it's harder for me to navigate in that world. Currency futures versus spot Forex. It's funny because in the spot Forex world, or the over-the-counter Forex world, really there's a whole bunch of different entities that are determining price, that are presenting price to you. And maybe they're using EBS pricing and some sort of equation to calculate what it is. But you literally could place the same Euro FX trade in 4 different over-the-counter Forex platforms and get 4 different prices, right? So pricing isn't really transparent or uniformed as it is in the FX futures markets. So that's kind of number one. You're not charged interest to carry over a position. You don't have 3 to 5 day settlements. In futures, currency futures markets has always been, in my opinion, the way to go. And I think you'll have a better experience considering that. And then finally, I just want to mention cryptos. I don't even know why it made my outline, but purely, in my opinion, crypto's purely speculative trading, right? There's no underlying asset or underlying, there's nothing tangible underneath it, right? So that's why I'm saying it's probably totally speculative. And the idea that, there could only be so many Bitcoins mined in total lifetime, well, that's great, but someone's just going to mine a different coin. I guess there's a dog coin and all sorts of different coins. So the technical analysis part of that is difficult because, again, it's not a uniform global market. It's a bunch of random little markets, and you don't know the volume, you don't know the bid-ask spread, you don't know all the stuff that's going on behind the scenes. So, I don't think, hopefully blockchain technology becomes maybe a standard for financial transactions, but I don't know that we're there yet. Okay, so let's go back over some of these questions. So that was pretty, we've covered a lot of ground right now, and I do want to go over and cover some questions. And we're going to start with the charts because there's let me just, we're getting late here, but that's okay. Don't worry, I got nothing but time. So this is a chart. It's you have access to these charts, and you get access to every tick of data if you want every tick of data. I have a 10-minute candle chart up here, pretty basic candlestick chart. And one of the really nifty things about futures trading is you get to see volume. I have it displayed as a histogram on the left-hand side, volume at every given price displayed. So you could see over the course of time, where is market equilibrium, where is price happiness, and maybe you could use this volume distribution and give you clues on how to trade. NinjaTrader, right click, and you get access to all this stuff, right? All this stuff. And let's just focus on indicators for a second. Open up the indicator box. This window comes up, and on the upper left-hand side is all of the different indicators you have access to. Many of these are, I have the order flow volume in the software version of the software up right now, and all of this stuff is available to me and it's available on a customized basis, right? So I could go ahead and do whatever type of technical analysis I'm interested in, and I could easily adjust my preferences on the right-hand side for each and every one of them. Highly customizable and very easy to use. Let me scroll back up here now that I've totally ignored everyone's questions. Okay, RTY. Let's go to RTY. Let's see what we got here. RTY. Here's RTY, Russell 2000. Let's go ahead and change this over, see if I can get an RTY chart up here. And I'm pretty comfortable I will be able to, or trading ladder rather. Here it is. Okay, here's the Russell 2000. Somebody asked about Russell 2000. And so let's just go ahead and let's again place a sample trade in, and we'll place a sample trade in. And now you could see, you get a lot of information from this view, right? You're going to see what the tick size is, $5. You're going to see your open P&L. You're going to see that it's traded in tenths, right? It's traded in tenths instead of $12.50 or quarter increments. And that's how you could figure out for any market, what's the tick size, what's the tick size. And you could do that. You could do the math easy, right? So I'm going to freeze it right now. 1, 2, 3, we're 5 ticks in our way, or against us rather, $25. So it's a $5 tick. That's the easiest way to do it. You want to look at your intraday margin. It's up here, $1,000 on your intraday margin. So that's kind of how you do it. Once you get involved, you could also look at if you just simply Google, NinjaTrader margins, and you'll see that, and you'll see contract specs as well. Or you can go to the CME Group website. It has a really good display, product by product. Let's see. Market Analyzer, right click and customize, right? Add instruments, create instrument list, add blank rows, all of these things. You could add columns. Here are the columns that are available on the Market Analyzer. There's a lot of them. I just have a relatively simple layout, and everybody who comes to my Tuesday, Wednesday trade idea events in the mornings, is that I think simpler is better usually, but you could customize this however you want. Again, right click does a lot of stuff here on NinjaTrader. It's really easy. You could trade from the charts if you want. I could hide this chart trader if I wanted to. And still place trades from the charts, simply by, just again, right clicking and placing a limit order to buy, and that limit order will be in sync with the trading ladder. I could cancel it or move it. So you could be really nimble on a lot of these things. And again, we're not going to go into too much detail on how to use any particular trading software. This particular trading software, we do those on Tuesday and Wednesday mornings. Hopefully everybody can participate. Micro Gold, Pammy Joe asks, yeah, MGC is the symbol, MGC. I don't have it up right now, but that's how you could find that one. Javon, I'm going to say you're right. I'm going to just say Mr. Parmar. How was that? How to read buy and sell orders. There's a lot of different theories on order flow and how to read order flow. And what I would say is it's a difficult thing to do, and it may or may not be necessary. But there's a lot of order flow tools here on NinjaTrader that you could try out, and you could try out free with the real-time practice account. All right, so I think we just went over the analyzer. We talked about you need a separate account for what you want to do, Cynthia. What is the indicator under the large MES chart? Okay, so right now, all I have on here is two things. The volume profile we talked about, and then this is the commodity channel index down here. It's an oscillator. There's a lot of different oscillators to choose from the indicator list. That's just the one I have up. You have MACD, you have RSI, it goes on and on and on. There's a bunch of them. And here's the list, all sorts of different types of moving averages. I usually add my moving average cross through this method. And there's just an awful lot of oscillators to choose from. This is just the one that, I've kind of grown up on and I'm used to. So it's the one I use. I can't teach an old dog new tricks. Let's see, let me scroll down a little bit more in the questions box. Dan, all right, so Dan asks, let's take this one. Are there trade fees? Yes, so in futures trading, you're traded per contract. And it's kind of a universal thing, right? You're traded per contract. And there's a couple different components to it. There's the commission that you would pay to your broker. There is a regulatory fee, small regulatory fee, and there's an exchange fee that gets paid to the exchange. And we've been talking mostly about CME group markets here, but typically those combined all together are typically a lot smaller than a tick, the size of a tick, right? So those are overcome usually with one tick in most cases, and they're all a little bit different, right? The exchange fees are different for different products. So as an example, it might be typical to have, a $5 all-in rate on any given contract. Again, most of the time, I think all the time, it's less than a tick, right? So it could add up, yes, but is it material in any given trade? In my opinion, no. Especially when you look at your purchasing power and your margin. RTY, we talked about RTY. And to figure out like the notional value of a stock index future, you pretty much take the value of a point, like $50 in the RTY, times the market price. That's how you figure out the notional value of a stock index future. When you place an ATM trade, Paul, after hours, yeah, it'll still work for sure. It's just at the end of the day, the exchange cancels orders, but you could actually place a ATM trade with Ninja, and it'll be effective for you. It'll still be working. So David asks how many ticks per point. It's different for each market. Like we saw in the Russell 2000, there's 10 ticks per point. In the E-mini S&P, there's 4. In the Dow Jones, there's 1, right? It's just, it's not fractional pricing. It's just the number. Here's the Dow right there, 34,679. There's no decimal point. So every point's a point. So it just depends on the actual market. It's all a little bit different. But for the S&P 500, it's 4 ticks per point. NASDAQ, it's 4 ticks per point. Crude oil is 10 ticks per point. Eric typed in the margin link for everybody. Thank you for that, Eric. Appreciate that. Antonio has, okay, so Antonio says usually you don't want to close that way right away because you might leave profits on the table. Wouldn't we want to close a price to sell? Yeah, so Antonio, so good comment. People do different things, right? Traders have different methodologies and different styles. And I think before we showed a trade idea where we had an entry, a stop, and a profit target. And that's kind of, in my world, that's the anatomy of a trade, right? And depending on, you're going to do your analysis, your technical analysis, determine what time frame you're going to trade, determine what your potential duration is on the trade, and you're going to place your trade accordingly. We go over that in detail Tuesday and Wednesdays on kind of best practices and kind of how I feel about order entry, stop management, and targeting. So feel free to join those. Hopefully you're able to do that. Richard, no, the spreadsheet was just something I just made up. Today's presentation. Everyone's asking me, can we see your PowerPoint? I'm not a PowerPoint kind of guy. But I did do the spreadsheet, which is unusual for me, but hopefully it was helpful. Go back and look at the recording, pause it, and you'll be able to see it again. David says power failed and lost connection. Please, oh no, please be sure to send me the link. I think if you registered through the website as opposed to YouTube or something like that, you're going to get you will get an automatic email in a couple of days with the link to this particular presentation. Otherwise, you could just go to the NinjaTrader YouTube channel. Okay, so Fuberson from YouTube says the difference between MA plus S and Renko and candlesticks, how to relate. That's beyond the scope of today, for sure. You're talking about Renko charts and specific trading charting technique, which is different than a candlestick charting technique. That's getting into a little bit more advanced stuff. So we don't have time to cover that. Unfortunately, we're over our hour limit, but that's okay. Eric says, what time frame would you say is best suited to submit trades on a 10, 15, 30 minute, 1 hour, or is that based on your trading style? Well, Eric, that's a great question. And we do cover that also Tuesdays and Wednesdays in the live trading events. But generally speaking, the nice thing about this software, the NinjaTrader software, is it's modular, right? So you could have, I could have an MES, a 10-minute MES chart side by side with a, let's do it. Let's just do it. With a 30-minute, with a daily, here's a daily. I could make it a 60-minute if I want. It's really easy. So you could have all your different time frames side by side. It's kind of number one. If you're using multiple time frames to do your analysis, personal trading style, right? My opinion, something got filled. We got word. In my opinion, in my technique, I take a 10-minute and I multiply it by 6 and I say, all right, I'm looking for a trade opportunity somewhere between a minute and 60 minutes in duration. I have a 6 times multiplier. If I was using a 30-minute to make my trade entry decisions, I'd have a 3-hour multiplier. Now that's just the way, that's my personal thing. And, I'm not any better than anybody else. So this is how I think. So it's totally up to you, Eric, how you want to configure that and how you want to create a strategy and get good at a strategy. Let's see. if you're having, Dennis, if you're having trouble, if the dome is too fast for you and you're having trouble getting your stops in, you can do it on the chart. I prefer chart trading, actually, to be honest with you, because what the chart trading allows you to do is really use the crosshairs to your advantage and pick a price and then right click and send your orders. You know, pick a price and then right click and send your stops. So I hear what you're saying when the dome is moving fast and you have a hard time getting those orders in, but consider doing it this way. It's really, in my opinion, it's a lot easier. So, and I'm really old, so I have trouble doing a lot of things. But anyway, hopefully that helps. Okay, so for exchange minimum margins, what the exchange margins are, the CME website's a pretty good source. Just go to CME, pick a product, and it'll have contract specs on it. Once you get to the contract specs section, you'll be able to, it'll say margins. And you'll be able to get to it. Which EMEs would you recommend timeframes for day trades? So what Jonathan's asking for, again, this is more technical analysis stuff that we'll talk about Tuesdays and Wednesdays. Exponential moving average, that's what EMA stands for. I prefer simple moving average, SMAs. And from a day trading point of view on a 10-minute chart, I use a 6-minute SMA, a six period SMA for my fast moving average, and a 26 SMA for my slow moving average. And that's how I make my crosses. Again, Tuesday and Thursdays, we go into that in so much detail, you won't be able to take it. Let's see. Paul says, if your contract rolls and your position is up, let's say 50 MES points, would you still be up 50 points, or would your entry price be at the current price? Okay, so that's a good question, and people get caught up on this a little bit. But when you're rolling over, remember, you're going to close a position and immediately open up a new position in a different month, right? So your effective price is the same, although you're going to book P&L on the first trade, and then your second trade is still in play, if that makes sense. That's the best way to look at it, I think, Paul. Bonds don't have a micro, no, Gene. Unfortunately, they don't. And again, bonds are my favorite because this is what I grew up on, U.S. Treasury bonds. But there's no micro for bonds right now. And I don't know if there's an appetite for it, to be honest with you. Bonds are, they're more of an institutional market, I think, even though I think for retail traders, there's some great opportunities there, but they're a little trickier. The U.S. Treasury bond market, in my opinion, is a leading market. It gets ahead of the news cycle sometimes. It's a very smart marketplace, but it does move in chunks, right? It's not, these stock index futures markets are fluent, right? They move up and down, oscillate all the time. They're moving. Bonds tend to move in chunks and discrete, boom, they move several ticks and then stop, kind of thing, I guess is what I'm trying to say. Chunks isn't actually a term of art. Let's see, strategy builder, can you please build a quick and easy buy the dip when the price equals across? Chris, I'm going to encourage you to come Tuesday and Wednesday. That's what we do. Tuesday and Wednesday, 9 o'clock Chicago time, 10 o'clock East Coast time. We spend hours doing it. It's a lot of fun. So feel free to come to those. They're free. Point of control, Terrence, again, we'd cover that again in Tuesday and Thursday events, but here's just really quickly, volume profile, or if using market profile, similar. The biggest histogram bar is the point of control, and there's not a lot of magic in that, right? There is a lot of magic in it, but it's simple. It's the histogram bar with the most volume. End of story. There's no complicated calculation. And the point of control is meaningful to me. Again, we'll go over it Tuesday and Thursday. I don't know if, Paul, is there a micro 10-year note? I don't think so. And if there is, don't trade it. I don't think that, there's not there. I don't think there's not a micro 10-year note that I would suggest you look at. So Robert, I just freeze the dome by putting my mouse on it. You know what I'm saying? I got the super dome. I just put my mouse in the price here and I froze it, right? And if I click on it, then I could scroll up and down after it's frozen. That's how I did it. So it's open, mouse on, click once on the price ladder, roll with your roller up and down. All right, so let's kind of move on here. We're running triple overtime right now. I apologize. We're going to be done in a few minutes here. Again, initial margin, consider initial margin, Eric, is overnight margin. It's what the exchange says you need to have in your account to carry your position overnight. And remember, overnight's a weird thing. It's only 1 hour long, 4 to 5 o'clock. Oh, excess initial margin is how much money, based on the size of your, how much capital you have in your account, that, how much extra initial margin you have, how much extra buying power you have. Okay, I'm scrolling quickly here. We'll cover all of the CCI stuff Tuesday and Thursday. Pay me, Joe. I think I just showed how to right click and put a trade on the chart. And we're getting back to how do you do support and resistance Tuesday, Thursday. How do I sign up for Tuesday and Thursday? I don't know. That's a good question. I'm going to show you maybe if I could find hang on a second. Let me struggle off screen here while I find the link for you, because I think I could find it pretty easily. There it is. Okay, so NinjaTrader.com/platform training. I'll copy and paste this into the event here, into the chat box. There it is. Live commentaries Tuesday, Thursday, 10 a.m. We've added another top 5 indicator on Wednesdays, Future Trading 101 Thursdays. So that's kind of the things I do. And then there's a whole bunch of other stuff on here as well. So I encourage you to go through, take a look at this list as you go through the discovery process of whether trading futures for you is right or not. Take the time and go through these things. They're pretty good. Okay. I think we got to the end here. I do. There's a lot of questions on technical analysis and charting techniques. Please come Tuesday and Thursday. I'll spend as much time as you need on that. And feel free to pop into any of those things. I want to thank everybody for coming. I do want to remind everybody trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. You get a lot of leverage in these markets combined with a lot of volatility, equation for opportunity, also an equation for risk. So be careful. And remember, past performance not indicative of future results. So I'll never talk about past performance. Other folks do. Be careful. Flag on the field a lot of the time. Finally, we were in real-time sim mode today on the NinjaTrader platform, and I just wanted to kind of end with that. Thank everybody for coming, and just end it with this. Be safe out there and be good to each other. Take care. Thank you.